More tariffs and hotter inflation. But do investors care? So January inflation came in hot. The headline CPI metric indicated inflation was up 0.5% month over month in January. That's well above the forecast for a 0.3% rise and further accelerates from December's hot 0.4% reading. The spike was largely driven by housing, gas, and food. Probably led by eggs. On an annual basis, overall inflation was up 3%. Meanwhile, core inflation, which strips out more volatile items like food and energy, was also up 0.4% month over month, also topping expectations and also accelerating from December. As we mentioned in our other videos, the Fed typically prefers to focus on the PCE index as an inflation gauge rather than the CPI or PPI, which comes tomorrow. However, while there's some differences in their makeups, all three are fairly correlated and a decent benchmark for actual inflation trends. Well, in just a single month of data, the hotter January adds to a string of stickier months that had the Fed pause its rate cuts at the last meeting. Bond yields rose today on expectations that rates will remain higher for longer, and market expectations for rate cuts got pushed out further. Just one cut is now expected this year. Markets initially sank after the CPI release, but mostly recovered by the end of the day. It was a similar story earlier in the week after reports of new steel and aluminum tariffs. Markets continue to remain very optimistic and seem to be looking for reasons to rally. We remain cautiously optimistic for hopefully a more favorable business environment on tap. However, we continue to monitor a lot of headwind pressures building up from increasing tariffs, sticky inflation, true job market strength, and just general uncertainty. We'll be getting more inflation data tomorrow from the PPI. Hopefully, it'll be more in line and cast the hot January CPI data as just an outlier.